I'm a reporter at Bloomberg in Frankfurt. I cover financial regulation, but also banking and financial markets more generally. And I have a great pleasure to moderate the panel on the future of benchmarking, because all the things we've heard about this morning and all the big picture stuff, this wouldn't happen without what's under the hood. And so we have to talk about what's under the hood today. And to do that, I'm joined by, starting from this side, Claus Hecher of BNP Paribas Asset Management. He's responsible for German-speaking countries, the distribution of ETFs to institutional clients, such as wealth managers, pension funds, insurers, as well as banks and other large distributors. We have Sanjay Rao, who combines the governance of indices with talking to asset managers, consultants, and owners to ensure that Bloomberg Barclays indexes develop in line with markets. So he's a colleague of mine. And last but not least, we have Lee Turner from Footsie Russell, who deals with global financial institutions to understand their benchmarking needs and then takes that feedback back to the business at Footsie Russell. She's been with Footsie Russell for 18 months, and before that was at Morningstar, so I'm looking forward to hear her perspective as well. Maybe I can jump in with you Lee, just to start with. Being a journalist, I get to be the skunk on the panel. I get to be the one asking the uncomfortable questions. But so if I was a grumpy investor saying, sort of, hey, I'm big fan of benchmarking, but there are so few suppliers of indexes or benchmarks. How do you respond? How do you counter that and say, hey, no, this is the value that we add?
So we get asked this a lot, and whether there's a concentration risk. I think a concentration risk applies that maybe there's a single provider, which could be a concern in our market for anything. We have a handful of providers that cover the large market cap, and we have a lot of upcoming providers too, which challenge us. So I don't really see as strong an issue with this so far, especially as we see more and more people coming up with ideas, which just help us up our game. Mm-hmm. So I don't think there is an issue right now. I think the reason you have sort of 3 or 4 at the top with the big market is because what everyone is trying to do is get a coverage across globally, and that takes a lot of resource to do that. And I'm sure Sanjay will talk about that as well, the resources involved from the bigger firms to make sure we have global coverage. That takes scale, and to do that you need sort of a lot of technology and research behind that.
Mm-hmm. And a lot of investment, I take it.
Well, go ahead, Sanjay.
Please go ahead.
To agree with Lee on that, I think investors generally gravitate towards a particular benchmark provider for a particular asset class, but all asset providers are looking to provide the range of asset class coverage and regions, because we need to be able to have all the building blocks to be able to develop new indices and innovate new structures. But fundamentally, I think from the investor perspective, they're looking for a consensus on what the market beta is, and that's why they generally go towards one provider for a particular asset class. But it's not like they are required to go to that. That's their choice.
Mm-hmm. Okay. Well, Claus, maybe you can also give us a perspective. I mean, do I really need a benchmark provider, though? I mean, I take these points, they're very valid, or can I just devise one myself? I know there are regulatory limits as a bank or an asset manager, what I can devise one. But I mean, how easy is it to find a kind of a boutique partner for self-indexing?
Well, I mean, there are enough offers out there. I mean, if the index providers are too expensive or don't deliver what I need to replicate in my ETF, then I can create my own index idea, ask index calculation agent to do the math and corporate actions, and maintain the index data, and I can track this index. Mm-hmm. The advantages of well-known index providers that from a marketing perspective, they are well-known names, and if you track indices from such index providers, it may also help to sell your ETF better. So it's a balance between fees you have to pay, because we are the license takers as the ETF providers, and the marketing effect from a good index provider.
Okay.
I think, go ahead. I think he hits on a great point there, because he's saying, well, I could do this, or do I pay for it? And so the question is not, are there too few providers? The question is, do our clients feel they're receiving the value for what they pay? And that's the question you need to be asking. And we try to deliver that value at Footsie Russell through the research and data and analytics we deliver back when you get that index. And then it's for them to challenge that they're paying enough to get that delivery.
So, sorry, just to
Go ahead,
make a
Sanjay.
slightly different point on that. A lot of the conversation in these discussions is around the index is a synonym for a passive product. And an index is more than that. It's about understanding the investable universe for a particular asset class. It's how an investor can understand what the market beta is, so they can look at active managers to see who's outperforming, but they can also look at who the passive providers are who can provide that market beta. And once you understand that distinction, then you can go to the next stage of trying to decide, how you should construct your particular benchmark for a product. But it's important that you recognize that the value that the index provider gives by defining a consensus for the market for an asset allocation is very important as a starting point for things.
Okay, point taken. Names, brands, trust, scale, all very important. But still, I mean, the issue of fees is so central to the ETF industry and the discussion we're having around ETFs. So at what point do you already feel pressure to lower your fees as the rest of the industry goes further and further, lower and lower?
From our perspective, I think we're very aligned with what the asset managers are doing. As the asset managers' fees are reduced, then our structures are looking to take into account that. I think the thing is, Bloomberg, we've invested heavily on data, pricing, analytics, research, and distribution, and that's part of our ethos, just giving these out at quality for value, and we've looked to leverage that on the index side to add that within our infrastructure. So I think we're trying to address that within all of the Bloomberg offering.
Footsie Russell perspective?
Yeah, I'd agree with Sanjay. I think 10 years ago we had a fee issue, and that fee issue wasn't just index providers; it was across the board, right? And I mean, I moved over here from Chicago 15 years ago, and was quite shocked by the fees people were paying. But I don't think we have that same issue anymore. I think our fees, just like yours, are aligned with the index provider or the asset manager. So as their fees go down, so do ours. So I think we're kind of at a point where I see a plateau coming. I think we've been talking about it for a long time. If we drop any lower, we run a risk, and that risk is that we'll lose efficiency in the product potentially, or we'll get to the point where only a few providers can create products if the fees drop that low. And we don't want that either, right? We want competition in product as well. So I think we're kind of at that plateau point. We've been talking about it for years, but now I feel I have less and less conversations about fees.
Mm-hmm. Claus, are you buying what you're hearing?
Yes, indeed. I mean, the question is also, do ETF providers really need to offer ETFs at 5 pips? It's like a Ryanair ticket at 19 euros. Mm-hmm. Is this good? I don't know. But I can understand that those ETF providers can no longer afford to license an index from any of the large houses, that they need to create something with an independent index provider, do almost the same at almost zero cost. Because, I mean, if you get 5 bips as a total expense ratio for your fund, you can't afford 4 bips license fee for an index. It doesn't work.
Mm-hmm.
But okay. To the idea of scale, I mean, the earlier panel discussed the risks associated with an ETF. So if you had a large product and you have an index provider that may not have the infrastructure to support that, what happens if the index provider can no longer provide the index? They don't have the backing, they don't have the infrastructure to be able to support that product going forward. That's a real risk associated with an ETF or any index. And so I think that's a question that needs to be asked. Is it worth having the low-cost price?
Okay. So I'm sure a lot of you came here today also to hear about ESG, and we'll be talking more about the future and innovation. But to that point, why don't we pull up one of these digi questions where we get to express our own opinions. So if you can pull out your phones, let's move over to the question for this panel as to the future of benchmarking. Put the future in the title of our panel. Live in 5 seconds. I'm looking forward to hearing your opinions as well as this. You're not getting away. It's not just the audience. So which asset class has the most room for index innovation? Equity, fixed income, commodities, or alts? Okay, and let's keep this voting. I will say that we've had a lot of different responses on this. My personal opinion, I thought it was going to come in on one of these categories. I was quite sure, but I've been surprised. How about you guys? I mean, Sanjay, you may be a little bit biased, given the debt focus, but how do you see it?
Well, so I think I've been in fixed income indices for more years than I'm willing to admit now. Mm-hmm. And the conversation has always been, if equity is the digital age, then fixed income is definitely the analog. I think we've got a range of issues that we need to address that are slightly more complicated, like the number of bonds, number of securities, transactions, liquidity, which means that we're much slower. So I think we really are playing catch up to the equity providers in terms of the range of types of assets. But I think with the larger data sets, that's something we're getting towards.
Okay. I actually had a Laserdisc system at home many years ago, so I can kind of understand. Okay, are we closing out here at this? So we have equity at 37%, fixed income at 21% on the third place, commodities at 16%, and alts at 26%. Oh, all right, no.
Keep talking.
I'll get my vote.
Okay, but I think it's interesting that at the moment we have equity there. I'm going to say it surprised me. I thought, but just look at the sheer number of different equity ETFs, I would be surprised that we have more potential to innovate there. But we'll come to that now, I guess. So on the does anyone want to pick up on equity? So, Claus, do you think have we indexed everything imaginable already in equities, or is there other concepts out there we could still, or plays we could be making on particular industries?
I mean, we are quite far already in equity space indeed, but I think investors always tell us that there's more need for a blend of ESG with factor indices, for example. That's an area to grow, and there's always an appetite out there for new thematic stories, which is simple from an academic point of view. You don't need huge models, but you need to watch out for new trends. I think the challenge here is to find enough liquid companies to create an index when you have an innovation phase. And this business is produced by startups or non-listed companies. So it takes some time until companies have successfully done their IPO and that the company size is large enough and that you find enough of these companies to create an index, because diversification is key for an index, and for an ETF provider, the all underlyings need to be liquid so that we can trade them.
Okay. On the point of equity, since we're in Germany, I've got to ask. So when I speak to, I'm a Brit, but I moved here many years ago. When I speak to my friends about investing in Germany, casino is a word I often hear in connection with equities among my personal friends, because they got burned, especially by the Deutsche Telekom IPO. People really, it's traumatized a generation, and I'm sure many people in the room have acquaintances who were similar experiences. So Claus, I want to pick on you again as the German on the panel. To what degree do you think, let's say we come up with an extremely innovative index focused on robotics or the Slim Index or something else, and they just craters and burns. Like, to what degree is there a reputational damage among whether institutional or retail investors from that focus?
Yeah, there's always a risk, but if you ask what is the new generation doing in Germany, they're watching closely equities, and I think they're ready to invest again. I think it's maybe the middle-aged generation like myself who went through all these telecom stories some time ago, and those people are not willing to save into equities for their pension. But the young generation is looking at equities again.
Okay.
And of course at ETFs, because they want their investments being cost efficient.
Okay. And then do you want to jump in on equities as well, Lee? Is there anything which you see an area for innovation there?
Well, it's jumped up to fixed income.
Oh.
Sanjay got his way. So, and I
voted
think
twice.
And I think like you said, I think there is more room for innovation in fixed income. It's just more difficult, and there's so many more challenges. But we all want to take that on. So what Footsie Russell is doing really, and I would go with the other, if there was another, is because we have both equity and fixed income, where we're seeing our innovation is in multi-asset. So when we look at what the banks are doing and the wealth providers, which I know a lot of you are from, they're trying to come up with better multi-asset strategies, and whether they be target risk or income generation or risk parity. And to do that, they need to be able to explain their performance. They don't want to necessarily be judged by a benchmark, because they're all trying to do something specific and not match a benchmark, but they still have to explain whether they're performing and the risk metrics. So we're really looking at building out the multi-asset range, which is combining the two, and to being able to give our clients better analytics around that.
Okay. And then, I should have spelled out ESG. It's a journalist's sin to not spell out acronyms. So obviously, Sanjay, on environmental, social, and governance investing, Can you tell us a bit more about what Bloomberg's doing in that space?
So on the fixed income side, we partnered with MSCI and launched our family of indices in 2012 on investment grade. And so when I would go to an ESG conference, I would see the name of an asset manager plastered all over the wall. Go back to talk to the portfolio manager from that asset manager in fixed income, and he would ask me what ESG was. So there was a huge bifurcation between what the central office was doing and the portfolio managers were doing. That's no longer the case. Asset owners have come through and they've explained that they want to integrate ESG into their fixed income allocations. They've looked to do that effectively. What we're seeing now is the progression through from investment grade into high yield and EM, which is a new offering that we're coming with, but also the definition of new terms. So what we've got is low carbon is an investment theme. Sometimes it feels like the slogan comes first and the definition comes afterwards, and that's really, I think, what we're trying to work through now. What does it actually mean to have reduced fossil fuels, low carbon? What do all these actual investment themes actually imply? And that's, I think, the discussion we're having with clients now.
Okay. Well, I'd love to hear more about that because, I mean, we're in Germany where, let's face it, nuclear power is not very fashionable, to put it mildly, but over a couple of hundred kilometers that way, in France, nuclear power is part of the answer for a low-carbon economy and for solving, climate change and other environmental issues. So how do you make sure that every client base is served, that the German asset manager and the French asset manager don't feel cheated on either.
Well, so I think 3 or 4 years ago it was that sort of level of differentiation. You would say that the Germans would say that nuclear power was the problem. The French would say that it was the solution. But you had even greater divergences. You had people running church mandates for North Germany versus church mandates for South Germany, and the criteria would be different, the thresholds would be different. Oh. So I think that's part of the job of the index, to be able to build that consensus over time. Mm-hmm. What we've seen on the ETF products on fixed income is that the transition from using socially responsible screening to ESG rating, there was 2 separate investment themes. Now they've been joined and they've been used across different asset managers providing products to incorporate both sides of that investment goal. So I think what we see is, as markets progress, it gets to a consensus, and that's when the market really takes off. And that's where I think we're at the beginning of now for ESG.
I'd like to come back to the consensus issue, but Lee, we also heard about due diligence on the previous panel. In your experience, whether the big asset managers or other institutional investors you speak with, do they actually do the due diligence? Do they look at what's on the tin and know what they are buying?
Well, I mean, Vanguard's encouraging them to. They said it twice today. I mean, so I think everyone in this room is, but I think we need to come a long way to help people. I mean, in my previous experience with Morningstar, we came over here and tried to show people it was under funds. When I started here 10 years ago, I called up an asset manager and said, "Can you give me your complete portfolio holdings?" And they said, "You're crazy. Like, that's what I do. Why would I let someone see that?" And I'm like, because they need to know what they own. And we've come a huge long way since then. So people are much more transparent. And that's what Footsie Russell is focusing on, is the transparency through the governance. So we think as we change, as markets evolve, and as we create ESG, what's most important is that you're able to understand what you own. And so we're creating the methodology, whether it be with a partner or with a government or whoever. And then once we have that methodology, we want it to be very clear and transparent what they own through that. Are they reading it? I think that's the role of the advisor. I don't think the average Joe on the street is picking up and reading it. So when I go see my advisor, I want him to tell me, this is what you own, or trust me, I've read it for you.
Okay. Well, trusting the advisor is important. And then so over at BNP Paribas Asset Management, when you think of innovation, what are the big things you're pushing at the moment where you really see the potential to differentiate yourself as well, Claus?
Yes, I mean, we as a company, the company as a whole has decided to become fully ESG compliant with all investment processes within the next 2 years. So obviously it also has an impact on what we offer in ETF space. We have a clear focus on ESG indices being tracked by our ETFs. So, I mean, the challenge for us will be to change some of the index from non-ESG index to ESG compliant indices in the future. That's our plan. And I think it's important to be there because the demand will be there For example, sometimes you need to think ahead. We were the first company to launch on low carbon ETF already 10.5 years ago. No assets for the first 8 years, but certainly the product has grown very nicely. And now this is a solution for the regulatory requirement we will potentially facing in the near future.
Okay. And if we think beyond ESG, maybe each of you could share your thoughts on a particular field of innovation which would really allow yourselves to distinguish yourselves.
Yes, smart beta fixed income, I think, is something what investors would like, more the sophisticated institutional type of clients. Because in equity space, the factor indices, I think it covers almost everything, but there is room. Commodity indices, I think we have everything already in place with very enhanced roll mechanisms, etc. I talked to a colleague recently from our real estate business, so they are looking now at factor investing in real estate. Interesting, I don't know what it is at the moment, but you see that people are thinking about new ideas beyond the securities markets.
Yeah, we do things with green real estate. I didn't know what green real estate was.
Yeah, green real estate is important because we also track for more than 10 years Footsie Russell indices, and obviously we also want to go green there.
It's so interesting. It's looking at every house or every building and saying, what is it doing to be green? And then there's a rating scale for it, and then that's how you can invest, essentially. I mean, I already mentioned multi-asset for innovation, but for sure ESG, and I would say ESG in fixed income. Every client that I talk to about ESG says, and what can you do with fixed income? And it's not easy because of the bond market. That's definitely an area we're heavily investing in. We recently acquired Beyond Ratings, which is a French company that does fixed income specifically ESG work. So we'll be able to do work with that.
Okay, and Sanjay, would you like to pick up on that point?
Yeah, so I think we've seen that fixed income is more complicated, also because of the private companies. It's been quite hard to actually find the right criteria to assess them without the public information. But I think, again, another thing that we've been working on heavily is factor indices. So we've seen the investment theme on the equity side grow assets. There's always been that same requirement for people to move what they're doing on the equity side to the fixed income side, and what is that translation? Now, obviously, fixed income is much more complicated in terms of, like, if you think about JP Morgan has one equity but 10,000 securities. The ESMA classification of liquid securities, they said there were 1,500 equities that were liquid in Europe and 470 of 70,000 fixed income bonds. So when you look at that divergence in structure, it's a much more complicated asset to implement. And that's where we've been working with clients to try and understand what exactly can we do, and how do we incorporate transaction costs to give you the risk premium return, but within the structure of whatever the costs of actually achieving that are. And that's, again, another conversation that we're having with clients. So we understand what the thematic of carry, trend, and momentum is, but how do you implement that? And then each client will have a different perspective of how to implement that. And it's really about us talking to them and engaging them and the investor over the process to try and find what the final solution would be, or the consensus solution is.
Okay. Sounds like there's a lot of interaction between I mean, issuers and clients and the benchmark providers. We could have had a whole other panel on this too. But since we're winding down now, I'd like to ask you to join me in thanking my panel for this great discussion.